Hi everyone, this is the part 2 of chapter 7 non-current assets acquisition and depreciation ACCA F3. So in the first part we have seen the theory part of this chapter. Now we'll be starting with the questions and we'll be starting with the methods using which you can calculate the depreciation. Before watching this, make sure that you watch the part 1. If you haven't, then the link of all the playlists is given in the description box below. So make sure that you watch all the previous chapters so that you will be able to understand this video better. And the rule remains same for this video as well. You need to have a paper, pen and a calculator with you. Otherwise, there is absolutely no point watching this video. Now let's get started. We'll finish the chapter in this video. This is very easy. And in the following videos we will also be doing the exam kit of all the chapters. So what are the methods of calculating depreciation? There are two methods using which you can calculate the depreciation. Before starting with the methods, let's do the important concepts which you have to learn before starting with the chapter. So make sure that you're writing all this. We're starting with the items. So the first thing which we have to study is the cost of asset. So what do you understand by cost of asset? So what is cost of asset? Cost of asset means that initially at what amount you have purchased a particular asset. At what amount you have initially purchased an asset. Let's say there's something for 4,000 rupees and you have initially purchased it for 4,000 rupees. So that is the cost of the asset, the cost at which you have acquired a particular asset. That is what is known as the cost of asset. Okay, now the 4,000, that is our cost of asset. So let's say that is a machine. Let us assume 4,000, it is the machine. You bought the machine for 4,000 rupees. Okay, so let's say that we used it for 20 years, and after 20 years if I have to sell my machinery, do you think I will get the entire 4,000 back? Today, after 20 years, if I want to sell my machine which I have been using for 20 years, how much money will I get? Will I get the entire 4,000? No, I will not, because the machinery loses its value after the period of time. So now if I sell it, I get only 500 rupees. Let's assume that I get only 500 rupees now, today. So this 500 rupees, what is this called? When I bought it, it was of 4,000. But today when I sell it, I am getting only 500. So what is this 500? This 500 is known as my scrap value. Scrap value or disposal value or residual value. All the three mean the one and the same thing. So the amount which I am getting when I sell my asset today is the scrap value or is the disposal value of my asset. Okay, now I hope you're writing all of this down. So now the 4,000 which I had initially acquired at 4,000, today I will be getting only 500 on it. So if you think about it, I have had a loss of 3,500, right? If you think about it, I have a loss of 3,500. So what is this loss actually? This loss is known as the depreciation. We have done this in the part 1 of this video, and you know what depreciation is. It is the wear and tear of the asset, right? So that is what happens, and we have had a loss of 3,500. It was initially 4,000 and I had a depreciation of 3,500, and then today if I sell it, I'm getting only 500. So 500 is the scrap value, 3,500 is the depreciation, and 4,000 is the cost of the asset. Clear with all this? Easy. Nothing is difficult in this. Now, what is useful life of an asset? For the number of years I have used a particular asset, for how many years I have used an asset, after how many years I am giving away an asset, that years are known as the useful life. Now let's take an example of a car, and I used it for 20 years. What is its useful life? 20. 20 is the useful life of the car. Okay, how many years I am using a particular asset, that would be its useful life. Now, moving on. So useful life will be given in the question always. It is the number of years. Okay. Now, if I have something and I used it for 10 years, what would it be? 10 would be the useful life. If I used a vehicle for 30 years, what would the useful life be? It would be 30. Clear with this word as well? Okay, now let's start with the methods using which you can calculate depreciation. There are two types of methods using which you can calculate the depreciation, right? The first one is the SLM or the straight line method, and the second one is the RBV or the reducing balance value method or the written down value method. And I'm sure that you have done these in your school, but we will do it again and it will be easy for you. Make this table, make this difference, it would be easy for you and it will help you in your exam. So reducing balance method or written down value method, both of them mean one and the same thing. Give me a second. So you can understand with the name of the same thing. In straight line method, the depreciation always remains the same. Every year you are charging the same depreciation, and in reducing balance method, you can understand by the word reducing, right? So reducing balance method means that the balance keeps reducing. So in straight line method, depreciation remains the same, and in reducing balance method, you know that we are reducing the balance, we are reducing the value, we are writing it down, so the depreciation changes every year. Okay, now before starting, now we have some formulas using which you can solve the questions, but before that let us take a quick illustration so that you'll be able to understand things better. Don't worry, right now things might be a bit seeming to be a bit complicated, but they're actually not. Let us quickly, I'll show you a practical example, and you are not going to solve the questions using this, but this is just for you to understand, and after that we'll be starting with the question. Let's say we have a car of 10,000 rupees or $10,000. Okay, now let's also say that using straight line method and reducing balance method, using both the methods, we will be doing the same question. So we have a car of 10,000. Okay, now the depreciation percentage will be given in the question. Let us assume it to be 10%. So we are doing it by straight line method. So depreciation percentage is 10%. 10% for reducing balance method as well. Okay, now so whenever these questions come, you make tables, you make a column particulars and a column amount, just like how we did with ledger. Okay, we can also make a date column, so let's do that as well. We will make a date column as well, that will make things easier for you. So you have three columns: the date, the particulars and amount. So you know that depreciation always takes place at the end of the year, which is 31st December, right? The year is from 1st Jan to 31st December. The depreciation always takes place on 31st December. So on 1st Jan we purchase, let's say on 1st Jan we purchase the car for 10,000. So on 1st Jan we purchase for 10,000, and on 31st December, what happened? On 31st December we have a depreciation, 10% depreciation. So what is 10% of 10,000? That is 1,000. So 1,000. So from the purchase value, you remove the depreciation. What will be the carrying amount? The carrying amount would be 10,000 minus 1,000, which is 9,000. That would be our carrying value. That would be our carrying amount on the next year's 1st Jan. Clear about that? Let's say it is 2002. On 1st Jan 2002, the carrying amount would be 9,000. You know that using the straight line method, the depreciation remains the same every year, which is 1,000 every year. Every year, the depreciation will remain the same on the cost value, right? So again, you subtract 1,000. So 9,000 minus 1,000 would be the 8,000. On the next year's 1st Jan, what would be the carrying amount? It would be 8,000. Now, again, the depreciation remains the same. Again, you will be subtracting 1,000. So, what would be the carrying amount? The carrying amount would be 8,000 minus 1,000, which is 7,000, and that would be our carrying amount. So I hope you got it. The depreciation remains the same every time the cost of asset, that only we will be keeping, right? Now let us do the same question using the written down value method or the reducing balance method. So we have 1st Jan purchase 10,000, 31st December we have depreciation, which is 10% of 10,000 again. What would that be? That would be 10,000 minus 1,000, which would be 9,000. Now moving on, the next year, what would be the depreciation? Would it be 1,000 only? Would it remain the same, or now it will change? Now it will change. We will always calculate the depreciation on the carrying amount whenever you are doing question on the reducing balance method. The carrying amount. The depreciation keeps changing in the reducing balance method. So now on 31st December, depreciation is 10% on the carrying amount. So that would be 10% of 9,000, which is 900, and we will subtract 900 from 9,000. What would the carrying amount be? The carrying amount would be 9,000 minus 900 now. Right, now again you have to calculate depreciation. And depreciation would be 10% on the carrying amount. Right, 8,100 is the carrying amount now. So 10% of 8,100, 810, we will minus that. So you are understanding the difference between straight line method and written down value method. It keeps changing every year. The depreciation value keeps changing every year. So 7290 is the carrying amount. Okay. In the SLM, the depreciation was the same. In reducing balance method, depreciation is charged on the carrying amount. So now you got it. That is what are the differences. Depreciation is same in SLM. Depreciation changes every year in RBM. So now that was just an example for you to understand the concept and understand how it goes. Now let's actually start with what formulas you are actually going to use in order to solve the questions. So when you have to find depreciation of each year, when you're doing straight line method, how do you find depreciation charged each year? So cost of asset minus the scrap value or the residual value divided by the useful life. This would give you the depreciation, which is supposed to be charged every year. This is what is the formula which you have to use whenever you are doing the question using the straight line method. Remember this formula well. You have to learn this formula because all of the questions will be solved using this formula only. Okay, you know what useful life is, you know what cost of asset is, and you know what residual value or scrap value is. Now we have already done the reducing balance method, that on carrying amount you have to every year calculate the depreciation. Okay, this is what is the carrying amount. We know what carrying amount is now. So yeah, so this is the theoretical part in the question. So we know that straight line method is used when assets provide equal benefits each year, like machinery, because machinery gives you the same benefit every year. So for assets like that, we use the straight line method. And in when you're doing reducing balance method, what do we do in that? It is useful for assets which provide more benefit in earlier years. For example, cars. In the initial years, we use them a lot, but after the initial years, we don't really use them as much. Now, IAS 16 says that depreciation method applied to an asset should reflect the pattern in which the asset's future economic benefits are expected to be consumed. What do you understand by future economic benefits? Future economic benefits means something that gives us the income or the operating activity, or which generates income for the business. Now, this is what straight line method is, and this depreciation charge per year, this formula, we have seen it. I have already explained this to you, and you know how to calculate depreciation charge every year using this formula. And we know that cost minus residual value upon useful life. So this would give us the depreciation charge for 1 year, and this is a very easy formula. You have to learn it. Now, you know what residual value is and you know what useful life is. We have discussed both of them very clearly, and you know that in straight line method, the depreciation remains the same every year. Read it quickly. Now we know what useful life is. We have discussed useful life very clearly, so let's not go into the detail of that. And we know what reducing balance is. We know that every year the percentage of depreciation charge would be calculated on the carrying amount, and we know what carrying amount is. We know that on the original cost, when you remove the depreciation, that would give us the carrying amount. Now let's discuss what accumulated depreciation really is. So what is accumulated depreciation? Accumulated depreciation is nothing but cumulative depreciation, which means together depreciation of your cumulative depreciation. Now let's take an example. Let's say in 2002 there has been a depreciation of 200. Let's say on 2003 there has been a depreciation of 200. In 2004 we have 200 again, and 2005 we don't have any depreciation and we are selling off our asset. Okay, now tell me, in 2004 I know that there was 200 depreciation. In 2003 I know there has been 200 depreciation. But if I want to know what has been the cumulative depreciation in 2005, how much depreciation has taken cumulatively till now, that would be the addition of all the previous years before, which would be 200 plus 200 plus 200, which would be 600. So 600 is the accumulated depreciation, which is the cumulative depreciation, which is everything together. Clear? So now let us quickly do the only journal entry which is there in the question, chapter, actually the most important journal entry. So that would be debit depreciation expense, credit accumulated depreciation. So this journal entry you need to always remember. You know that depreciation is a loss, and you know that losses are always debited. So depreciation expense, not a loss but it is an expense. So loss and expense have the same rule. All expenses and losses are debited. So depreciation expense account gets debited and accumulated depreciation account gets credited. So just remember this formula or the journal entry well, which is depreciation expense account debit, accumulated depreciation account debit. Okay, now there's one more concept you need to learn before we start with the question, and now let me tell you what that is. Sometimes what happens is, let's say that I have an asset 1st Jan to my financial year is 1st Jan to 31st December. Okay, and you know that always depreciation takes place at the end of the year, which means it takes place in 31st December, right? If I purchase an asset, let's say on 1st April I am buying an asset, then how will I calculate depreciation? See, from 1st Jan to 31st December, if I calculate the depreciation, it would be for the whole year, but the asset came into my business in April only, which means I have to actually calculate the depreciation from April to December only, right? But if I calculate for the per annum basis, then it will come for the entire year, which is not wrong. So what will I do in such a situation? You will prorata it. And you will find out only for the number of years, right? So let's say the depreciation for 1 year is 1000 rupees, and if I got it in April, then for how many months I'm using? April, May, June, July, August, September, October, November and December, for 9 months only. So then how will I find? 10,000 is for 1 year divided by 9 upon 12. This would give me the value for the 9 months. What is that? 750. So now I know that this would be my depreciation value. So for how many months or years, for how many months you actually use the asset, for that many months only you will be accounting the depreciation. Let's say I have an asset and I sold it on 2nd July. Okay, 1st July. I sold it on 1st July. Will I account the entire year's depreciation? No. So you will have depreciation only from 1st Jan to July. Right, Jan, Feb, March, April, May, June, July. So only 7 months depreciation. So whatever 1 year depreciation multiplied by 7 upon 12. So this is what is pro rata basis, wherein you will actually put the pro rata depreciation which has been charged for the particular years. Now, there is another method. So the first one we saw was the pro rata basis. Now you know what pro rata depreciation is. Now what is the second one? The second one is our year of acquisition, full depreciation, year of disposal, no depreciation. So this is the second method. So the first method is the pro rata, which means that for how many months you actually had, for that many months only you are calculating the depreciation. Now the second method is that the year you are purchasing the asset, even if you have used it only for 4 months or 6 months, still charge the entire depreciation for the whole year. But the year you are disposing of the asset, in that year have the depreciation as 0. Do not calculate the depreciation for the year in which you have sold it off. So this is the second method. We will do the questions and you will be able to understand it better. So yeah, asset bought or sold in the period. This is what we have discussed right now. If a non-current asset is bought or sold in the period, there are 2 ways in which the depreciation could be accounted for. The first one is that provide full year's depreciation in the year of acquisition and none in the year of disposal. The second one is the monthly or pro rata depreciation based on the exact number of months the asset has been owned. This is the first method which I have told you. Now let's start with the illustration. So this is the reducing balance method. You know the reducing balance method now. Dev, a trader, purchased an item of plant for 1000 on 1st August 2001, which he depreciates on the reducing balance 20 per annum. What is the depreciation charged for first 5 years in the accounting year end is 31st July. So they have already told us that the accounting year ends at 31st July. If nothing is given in the question, you will assume that the accounting year is from 1st Jan to 31st December. But this is given in the question that 1st August to 31st July is the accounting period. This is already given in the question. So when will the depreciation be charged? 31st July, right? Now, let's start with this question. So we need to calculate for 5 years. So what you need to do? First, you need to make a table. So we have date, we have particulars, we have amount. Let's start. We have date, particulars and amount. So on 1st August, I hope you're doing it along with me, otherwise there's no point. 2001, they've purchased for 1000 and we need to do reducing balance 20% per annum. So 31st July, we have depreciation. So on 31st July, we have depreciation which is 20% of 1000. What is 20% of 1000? 200. So 1000 minus 200, what would be our carrying amount? Our carrying amount would be 800. Now again on 31st July next year, what happens? On 31st July next year, depreciation again is getting calculated. 20%. It would be on carrying amount, so 20% on 800. So that would be 20% of 800, which would be 160. You are going to subtract 160 from 800. The carrying amount would be 640. So you know how to do it. This is a very simple question. So like this you need to do for 5 years. So this is the first year, this is the second year. Again from here you calculate. Like that you need to do for 5 years. I'm leaving this question here. I'm sure that you can do it well by yourself. And in the year end, the last year, I will just give you the answer. The answer would be 82. Right. The answer would be 82 in the last year. The last year's depreciation would be 82. It's very easy. No doubt at all. See, they have also done the question like the way we have only done. But if you make a ledger account like how I'm telling you, it will be easier for you to do that. So they have also done the same thing. The last year would be 82. And we know what accumulated depreciation is. It is basically just cumulative depreciation, wherein here we have 200, next year we have 160. So this year's cumulative depreciation would be this year's depreciation plus the previous year's depreciation. Okay, let's start with your test understanding 2. Read it. Karen has been running a successful nursery school, Little Monkeys, since 2001. She bought the following assets as the nursery grew: a new oven for the nursery kitchen at a cost of 2000, purchased on 1st December 2004. So they have given us which asset she bought and what year it has been purchased. A minibus to take the children on trips for 18,000, purchased on this date. She depreciates the oven at the straight line and the minibus at the reducing balance. A full year's depreciation is charged in the year of purchase and none in the year of disposal. So this is to be kept in mind that they have given us that on the year of acquisition you need to charge the entire depreciation, and on the year of disposal you need to charge 0 depreciation. Now we need to find out what is the total depreciation which has taken place in her business. So now let's start. First let us depreciate the oven. Let us start with the oven. So in the question it has been given that we need to do the straight line method in oven, and the percentage has also been given as 10%, and oven has been purchased initially for 2000 in 2004. So let's start with that. So in 1st December she purchased the oven, right? For how much did she purchase it for? She purchased it for 2000. Now on we know the accounting year. The accounting year has also been given here, that the accounting year ends at 31st October 2006. So what does that mean? What does that mean? That the accounting period is from 1st November to 31st October. Right. So depreciation is calculated on 31st October. So on 31st October 2014, how much depreciation has to be calculated? Depreciation is straight line method, 10%. 10% of 2000 would be 200. So we have 200. What would the carrying amount be? 2000 minus 200, which is 1800. Now we have, give me a second. Now on the next year's next year again we have depreciation. Since it is a straight line method, the depreciation remains the same. It would be 200 again. So the carrying amount would be 1600. This would be the carrying amount. Let's go back to the question now. What is said? That we just need to calculate the depreciation till 2006. 2006. Okay. Now we made a mistake over here with the dates alone. So this is 1st December 2014. So this is 2015, right? 31st October 2015. And here we have to write 2016. right? After 1st December 2014, 31st October 2014 doesn't come, right? 15 only comes. So we just made a mistake with the dates, and that's okay. So that's it. We are done with the oven. Now, how much depreciation has taken place on the oven on 31st October 2016? 200 has been the depreciation on 2016, right? Now, let's go to the question again. A minibus. So a minibus has a depreciation of 25% on the reducing balance, and it was initially bought for 18,000 on 1st June 2014. Okay, let's do that also. I hope you are also writing. So minibus, we have date, particulars and amount, and on 1st June 2014 she had purchased it for how much? Go back to the question and check. She purchased it for 18,000, and this we have to do with the reducing balance method, and the percentage of depreciation is 25%. So on 31st October 2015 she charges depreciation 25% on 18,000. So what would that be? 4,500. So 18,000 minus 4,500, what would that be? 18,000 minus 4,500 would be 13,500. Now, that is what happened in 31st October 2015. On 31st October 2016, again we have to charge depreciation, would be 25%. Would it be on 18,000 again? No. Why? Because this is not straight line method, this is reducing balance method. It would be on the carrying amount, which is 135,500. So 25% of 13500, which would be 337 and 5. I hope you are doing it along with me. So what is the carrying amount? The carrying amount would be 10125. Okay. We purchased it in 1st June 2015, right? We purchased it in 1st June 2015. We purchased in 1st June 2014. So on 31st October 2014 will also take place. Why? Because after June, October is there. So don't make this date mistake. Okay. So this would be 15. So we have to calculate for one more year because we need for 2016. So again 31st October 2016 we have a depreciation which is 25% on the carrying amount. So that would be 100,125, which would be 2531.25, and subtracting that we will be left with, okay, whatever the carrying value is. Now on 31st December how much depreciation has taken place? 253125. In the question, let's go back to the question. The question says, what is the total depreciation which is charged in 31st October 2006? So in 2006, in the microwave we have 200. So we have 200 depreciation in the microwave. What about the minibus? In minibus we have 2531.25. This is the 2016 depreciation, right? So that would be 2531.25. Adding them, what would be the answer? 200 plus 2531.25, that would be 2731, right? It would be 2731.25. Let's go to the answers and see if our answer is there. 2731, is 2731 there in the answer? Yes. So D is our answer. Clear? No doubts, because we wanted the depreciation as on this year. Now let's go to the test understanding 3. Read the question, then we'll start with this, and I hope you're solving it along with me. Okay, the following information relates to Bangers and Smash, a car repair business. So Bangers and Smash is a car repair business, and we have been given machine 1 and machine 2. We have been given the cost of both. We have been given the purchase date of both. We have been given when they both have been purchased. The depreciation method for machine 1 is straight line method. Pro rata, you know what pro rata is. We have discussed it. And machine 2 is also reducing balance. So what is the total depreciation for the years ended 2015 and 2016? Okay. So since nothing else is given in the question, we will assume the financial year to be 1st January to 31st December. Right, 1st Jan to 31st December is our financial year. In the machine 1, we bought it in August. So, if we bought it in August, for how many months will the depreciation take place in the year 2005 or 15, whatever? August, September, October, November, December, just 5 months. So in the first year of purchase, only 5 months depreciation will be calculated, because in the first year we have used it only for 5 months, right? What about machine 2? We have not purchased it in 2015, we have purchased it in 2016. We have purchased it in October. So for how many months depreciation we need to calculate? October, November and December. It would be 3 in the first year, which is 2006. Okay, let us start making the tables for both of them and starting with both of the questions, and I hope you are also noting everything down and make the ledgers or the how and calculate the depreciation of both of them and come up with the final answer, and then you can check it with me. So this is the pro rata basis, don't forget that. So we have machine 1, we need to do straight line method, which is 20% at pro rata basis. So we make a ledger, which is date, particulars and amount. So 1st August 2015 we are purchasing, and we are purchasing it for how much we are purchased. Go back to the question and see it, for 12%. And on 31st December 15 we need to find the depreciation. So the depreciation would be 20% of 12,000, right? But we have used it only for 5 months in the first year. We have discussed that. We bought it in August, so we have used it only for 5 months. 5 upon 12. So what is the depreciation? 1,000. What is the carrying amount now? 12,000 minus 1,000, which is 11,000. In the next year, we will put depreciation for the entire year. Why? Because we have used it for the whole year now, right? So moving on to 31st December 2016, we have depreciation, which is 20%. 20% on how much? On 11,000? Am I right? No. Why? Because this is the straight line method. It would be on the cost value only, which is 20% of 12,000. Depreciation remains same every year. That is right. But here we had to prorate it because we have used it only for 5 months. But that is not the case in the next year, because you are using it for the entire year. So 20% on 12,000, which is 2,400, and the carrying value would be 11,000 minus 2,400, which would be 8,600. So what is given in the question? Moving back, we need to calculate the total depreciation on 31st December 15 and 31st December 16, right? So let's stop here because we calculated 16 and 15 over here. Now let us do for the machine 2 now. M2. So we know what machine 2 is. It is written down method, or the reducing balance method. That's what it's called in your books. So you know that the reducing balance method, it is 10% given in the question. 10%. So let's start with the table first. And we have purchased it on 1st October 2016. On 1st October 16 you have purchased your machine 2. So we write the purchase value, that would be 8,000, and on 31st December 16 we do the depreciation, which is reducing balance method 10%. So we have 10% on 8,000, but we have used it only for October, November and December, right? We have used it only for 3 months in the first year. So it would be 3 upon 12, which would be 200. minusing 200 from 8,000, you get the carrying amount, which is 7,800. So that's it, we stop here because we have 2016. Now first let us see the total depreciation of the year ended 2015. So in M2, what was the depreciation in 2015? Nothing. Why? Because we bought the asset only in 2016. So 2015 depreciation. How much was the depreciation for machine 1 in 2015? It is 1000. Okay. Okay, so let's write that. In 2015, we had a depreciation of 1000. What about 2016? How much depreciation has been taken place in 2016? In the M2, we have a depreciation of 200. In M1, we had a 31st December 2016 depreciation of 2400. So we'll add both of them. 2400 plus 200, which would be 2600. So we have 1000 and 2600. Let's go to the question B. 1000 in 2015, 2600 in 2016. Clear? No doubt? Go back to the video, watch the entire video again if you have any doubts. Okay. Now we have accounting for depreciation. So these are the journal entries which I have discussed, which is debit depreciation expense and credit the accumulated depreciation. And always remember that depreciation expense goes to the profit and loss account because it is a loss, and accumulated depreciation always goes to the statement of financial position or the balance sheet. Okay, so how is it shown in the balance sheet? We have the cost of the asset minus the accumulated depreciation, which means we have the cost of asset, and till date whatever depreciation has been taken place, that will be minus. Then we will be left with the actual current value or the carrying amount of the asset. Let's go to the illustration 2 now, and let us quickly do the illustration 2. Read it and then I'll start solving it. Pause the video and read it. Okay, so Santa runs a large toy shop in Windsor. In the year ended 31st August 2005, she bought the following non-current assets. So these are the assets she bought, and Santa charges depreciation on a monthly basis. What is the depreciation charge for 2015? Show the relevant ledger accounts. Okay, financial position. Ledger accounts are nothing but journal entries. If you know how to do journal entries, you will be able to do the ledger account, no doubt about that. And how to put things in the statement of financial position, that is the balance sheet. You have to have the cost of the asset, you will minus the accumulated depreciation, and then you will be left with the carrying amount of the asset. Clear about that also? So you can do this by yourself. If you can't, then I will help you out, but I'm not going to discuss the ledger accounts because this is very easy. We will just be doing the journal entry because in the exam also the journal entry will only come, and if you know the journal entry, that means you will also be able to do the ledger accounts. So let's start with this question. Pause it and read the question, and then I will discuss the solution. So let's start. So what is the accounting year in the question? If you read it again, it is 1st September to 31st August. So first we will make the cash register account. So you won't be able to understand if you're not solving it along with me. I'm just quickly discussing the answer. So on 1st December 2014, you purchased the cash register. That's what is given in the question, for 5,000. And you have been given the depreciation as well. So on 31st August 2015, you have been given the depreciation, which is 10% of 5,000, but you have purchased it in December 14, so it would be multiplied by 9 upon 12, right? That would be 375. Subtracting that, the carrying amount would be 4625. That is the cash register. Now let's go to the delivery van of Santa. Whatever's given in the question, go back and check that. On 31st of 15, what's the carrying amount? Okay, I hope it's matching with your answer. Matched. Go and check it with our answer. It's the same thing. Ledger accounts are the same thing with the how you write the journal entries. No doubt about that. And statement of financial position, this also, we have the cost of the asset, we are subtracting the accumulated depreciation, and we are writing the carrying amount. Now we have test to understanding 4. Let's quickly do this also. We will not do the ledger accounts because I told you if you do the journal entry you will be able to do the ledger accounts. Coco acquired 2 non-current assets for cash on 1st August 2005 for use in her party organizing business. A property with a 25-year useful life for 2 lakh with no expected residual value, a chocolate fountain for $4,000. The fountain is to be depreciated at 25% per annum using the reducing balance method. A full year of depreciation is charged in the year of acquisition and none in the year of disposal. So, which means it is not pro rata. This is the other method. This is not pro rata. Let's start with this. Start with it. It's very easy. So what did you understand in this? This is the straight line method. A property with 25-year useful life with no expected residual value. So you know the formula, cost minus residual value upon useful life. Cost is what? 2 lakhs. Cost minus residual value, no expected residual value, which means 0. Upon useful life is 25. So which is 2 lakh divided by 25, which is 8,000. So 8,000 is the depreciation which is to be charged every year. What about chocolate fountain? 25% per annum using the reducing balance method. So every year 25% on the carrying amount. No doubt about that. You can do it by yourself, right? No doubt in this. I have given you the hint and everything. You can do it by yourself. No, try it by yourself. Okay, now this is the last concept in this chapter, which is changing estimate. So this is also very easy. So what is changing estimate? Sometimes what happens is that after a period of time, the business changes the estimate value. Like in 2002, I think that I'll be able to use my machinery for only 5 more years. But after 5 years, now I think I can use it for another 5 years because it is still functioning. So then my useful life of the asset will change. So what happens in such a situation? In such a situation, what happens is that you will simply change the formula and you will be using the new useful life. Till now, I have used my useful life was 5 years. But after 5 years, now I think I'll be able to use it for another 5 years. So my useful life will be 5 again. Or let's say now I think I'll use it for another 15 years. My useful life will change to 15. So it's nothing. What you have to do is you have to just do the new method now. Till now whatever has happened has happened. Now we are changing the estimates. Okay. Alfie purchased a non-current asset for 1 lakh on 1st January 2002 and started depreciating it over 5 years. Residual value was taken as 10,000. Okay. On 1st January, a review of the asset lives lives was undertaken and remaining useful life of the asset was at 8 years. Okay. And the residual value was nil. Calculate the depreciation that has been charged. Okay. We'll do that. We'll start with this now. Let's start with illustration 3. So we know the formula of SLM, cost minus residual value upon the useful life, right? So here we have cost is 1 lakh minus residual value, which is 10,000 given in the question, minus 10,000 upon useful life, which is the 5 years. So 1 lakh minus 10,000 divided by 5 years would be 18,000. So 18,000 would be my depreciation per year. Right. Now tell me. Let's read the question further. So on 31st January 2003, a review was taken and the remaining useful life was 8 years. Now the remaining useful life is 8 years. Okay. Let's now start with the question so you'll be able to understand. So we know that 18,000 per year is the depreciation, right? Asset account, which is date, particulars, amount. So on 1st January 2002, we purchase it for 1 lakh and depreciation every year is 18,000. So on 31st December 2002, we have a depreciation which is 18,000. Using straight line method, we calculated using the formula. So 18,000, that would be nothing but the carrying amount would be 82,000. Now on 31st December 2003, we need to calculate depreciation again. But on 1st Jan, we have revalued the entire thing, right? Here we have taken the remaining useful life was 8 years. So now what we need to do? The same formula, cost minus residual value upon amount upon useful life. So what is the cost now? The new cost would be 82,000. So now we'll use the same formula, 82,000, which is the carrying amount, which will be the cost of asset, minus the estimated value, which is nil, divided by useful life. Useful life is 8. This is the new value, the new depreciation, which is 82,000 minus 0 divided by 8, which is 10250. Right? So depreciation would be 10250 because we have calculated it here. So 10250. Now the carrying amount would be whatever is the carrying amount, you can calculate. So you got what we did. Initially till 2003 we have been using the normal method. Now we need to calculate a new depreciation. So till here we have calculated normal depreciation. Now again we will calculate depreciation using the straight line method formula. Here cost will be the carrying amount and everything else will be just how we have charged. Clear? You got it? That's the same thing they did. Okay, let's quickly do the test understanding 5. Alberto bought a wood burning oven for his pizza restaurant and for $30,000 on 1st January. At the time that useful life after 20 years would have no value, on 1st January Alberto revises his estimations. He now believes that he will use it for another 12 years and he'll be able to sell it. So for this is our scrap value or the residual value. So now we need to calculate depreciation again. So this is again the same way we have done the illustration, right? So initially what happened? Initially what was the depreciation per year? Cost minus scrap value, which is 0. Initially we had no value, upon useful life, which is 20, right? So that is what? 1500. So 1500 was the depreciation which is to be calculated every year. Then on 1st January 2003 it has been revised. So we'll come to that also. So let's start making our ledger. Depreciation is 1500. We calculated over here. This is our carrying amount. Now again depreciation would be 1500 only. Right? So what would be the carrying amount? 27,000. Now we have 31st December 2012. What will be the depreciation? Let's go back to the question. She has re-estimated the value from 2003 1st January. So what is the thing again? So cost minus scrap value upon useful life. So scrap value now is 1500, useful life is 12, and the cost would be the 27,000. So what is the new debt? 25,000. Okay, wait, we have to do in 2013. Okay, so I have done the same question here. We have purchase, we have depreciation 1500, and this would be the new depreciation. So this is the answer. Please check it with yours, and let's see the answer now. So the correct answer is 2000. We got 2000. The new depreciation. We know how to do this also now. So that's it. We are done with this chapter. I hope you understood it. Make sure that you check the description box below for the other videos. Thank you.